Hello and welcome to another video on how to secure yourself financially. So in today's video, I'm going to focus on the financial statement ratios and calculations. So over the past couple months, I went over to this beginner guide to financial statement to understand the basics. And the basics, they're not difficult. So if you are able to read nutritional labels or baseball box score, you can learn to read the basic part of financial statement. And if you can follow a recipe or apply for a loan, you can learn the basic of accounting. So much like the CPR course, this cardiopulmonary resuscitation course teach you how to perform basics of that, much like these sections will teach you how to gain understanding of this financial statement, and also it will train you to be much like the CPR course won't train you to be a cardio doctor. This won't train you to be an accountant, but it can give you confidence when you're able to see a set of financial statement and to make sense of it. So with that, after those statements or this financial statement, they show you the money. And there are four types of them. You have balance sheet, that is a snapshot of the company assets, liabilities, and shareholders' equity over a period of time, quarterly, annually, most of the time. Income statement show the net increase or decrease. Income statement show how much money a company made and spent over a period of time. And the bottom line of that statement shows you that the net income, and you can think of that as a set of stairs that you start at the top with the total amount of revenue, and once you go down one step at a time, you can make a deduction associated with that cost or associated with that earning. So for example, merchandise returns and discounts, and then once you go down to the first step down the stairs, you reach to the net revenue. Keep going down, you deduct things like the cost of sales among other expense to reach to gross profit, and then you deduct things like operating expense and amortization and depreciation until you reach the operating profit before interest and income taxes. And these interests are any activity that a company involves to ask loans or offering loans. For example, money market fund is a good example of that, among others, certificate of deposits. And then once you deduct that, the interest and the income taxes, then you know how much money a company made. So this is the overall perspective of the income statement. And then I look at the cash flow statement that report the company inflow and outflow of cash. And this is very important because company need to have cash, much like person need to have cash to purchase assets or pay expense. So it reviews the information from the balance sheet and the income statement, and the bottom line of this statement showed the net increase or decrease in cash, something that I'm going to apply by using an accounting software called Soho. So I need to know my cash flow and how much money do I have, all right? So this statement review the cash flow from one of these activities: operating, investing, and financing. So operating focus is on how a company is raising funds by analyzing is the net income and conciliate that with the total amount of cash that was used or perceived by operating assets and liabilities, operating activities. So, most common operating assets, you have things like accounts, uh, yeah, um, accounts receivable, uh, property, plant, and equipment, prepaid expense such as premium insurance, like health, home, vehicles, liabilities, long-term care, disabilities. Keep looking at another prepaid expense like marketing, rent, maintenance contracts, software license. Another common operating asset is the intangible assets such as patent, trademark, copyrights, trade secrets, as well as goodwill, customer relationships. Also, investment in affiliate is another common operating assets, such as joint ventures like Crocs and Post Malone, equity investment such as Berkshire Hathaway, Alphabet, SoftBank, Texas Pacific Groups, money markets, and cash equivalents, such as the money market funds, which are funds that involve in the purchase of a large volume of very short financial uh, debt instrument, such as bank acceptance, certificate of deposits, commercial paper, repo, repurchase agreement, or U.S. Treasury bills. And with that, uh, I also look at the most common operating liabilities, such as accounts payable, accounts payable, accrue expense, such as administering salaries, rent, utility bills, taxes, deferred revenue, such as subscription service, or which are obligations that a company has to provide good and service in the future based on money that was collected. Subscription service, gift cards, also income taxes payable, whether it's corporate taxes, withholding taxes. This is when your employer take a deduction from your gross wage salaries and pay back to the government. This is to promote the pay as you earn tax system and to fight tax evasions. Sale taxes such as VAT, GST, local, state, federal, foreign, as well as excise tax. And also, uh, keep looking most common operating liabilities, such as uh, short-term borrowings, okay, whether it's from banks or line of credits, other business, trades loans, where you now renegotiate with your suppliers and vendors, as well as outstanding invoice or payroll advance for your employees. And notes payable, which is an agreement between the borrower and the lender that it outline all the conditions of that loan. So whether it's for bank, anytime you ask a loan for the bank, it generates these notes payable, or for business. So for example, when you go to financial institutions, whether it's private equity or venture capitalists, as well as the um, trade, yeah, trade payables. You renegotiate that with your suppliers and vendors, individual or small business, warranty obligations. Okay, but this is just the most common operating liabilities, or to recap, the most common operating activities that a business involve, and how the first part of the cash flow statement analyze the net income and conciliate with the total amount of cash that was used from these activities, from the operating activities. So what it does is to look at the net income and conciliate that with the total amount of non-cash items that affect the income statement, that no cash involved, that when there is no cash involved, such as amortization and depreciations, stock-based compensations, as well as looking at the total amount of cash that was used from other operating assets and liabilities. So it is quite complex here for as an accountant, looking at that. The other is the investing activities. This usually, generally, involve is the purchase or sale of long-term assets such as property, plant, and equipment, investments, intangible assets, patent, trademark, copyright, trade secrets, goodwill, leasehold improvement. So then I look at the financing activities, that these sections focus is on how companies raise funds from investors and pay back through capital markets. So with this, uh, this section helps investors to see how a company is raising funds, how often, and where that money came from. Because if a company constantly raising funds from it is uh, death, or by issuing death or taking out of death. So by issuing death or issuing equity or taking out of death, that might not a good sign of investment. However, if a company, most of the time, it is cash flow come from operations activities, that is a good sign of investment. And most of the time, this generally involve the uh, raising funds from investors, repaying debt, and share that to shareholders, or they give out the dividends. So, for example, you have issuing equity, issuing debt, as well as repayment or repurchase stocks, repaying debt, leasing. So, with that, okay, they also look at the footnotes, which are very, very important because it packed with information such as significant accounting policy and principles of how this company is adhering to the accounting practice, and they must disclose sensitive information for that. Okay, so whether it's GAAP, the generally accepted accounting principle, or the EFRS, which is the International Financial Reporting Standard. Okay, well, the whole point of this is to do the scalability of business and becoming now multinationals, where now they are need to conciliate their financial statement across different countries. So they creating this set of, or the accountants creating this set of standards So to make it consistent, transparent, allegedly, and easily shareable across the world. So also I look at the income taxes. These sections talk about is in detail about local, state, federal, foreign taxes, as well as deferred taxes. Uh, Another section is the pension and post-employment programs, where now here is discussed things like the cost of this program, as well as how fund, how over or underfund those programs are, and the stock-based compensation, which is a type of financial instrument. When we talk about financial instrument, this is just an asset or a package of capital that can be easily shared. Okay, so this financial instrument allows the owner to buy, but not the obligations. Uh, yeah, allow the owner the right, but not the obligation, to buy a specific. What do you call it? Uh, to buy a specific stock or assets at a given upon price and date. Okay, so you have two type of stock options. You have puts and you have calls. So we're at puts. Okay, these are bets that the stock will fall, and calls are bet that the stock will rise. So this stock options is known as equity derivative, or is known as derivative, where their underlying value is on an asset, a group of assets, or a benchmark. And according to investor opinion, all of that. So with that understanding, okay, and then I look at the MD&A, which is the management discussion and analysis of financial conditions and report operations. The whole point of this huge sentence is to give investors, or the whole point of this is to provide investors more context about the financial statements from the management eye about important trends, risks that have shaped the path of the company, and likely shape the company's future. Okay, so for example, here in the AMD, the AMD of this is something that you can find in the thank you of Amazon. Okay, so this section is also something that talk about more about the macroeconomics of that. So thank you is a form that you can find that information. The thank you is thank you. No, it's a thank you. Annual feelings. Thank you. That's right. Is thank you, not thank K. Quarterly feeling. Exactly. Quarterly from 2023. Okay, and here, so when you navigate to the management discussion and analysis of financial conditions and results of operations, you get this. Okay, so this is when you look at this, for example, forward-looking statements, critical accounting estimates, inventories, income taxes, liquidity and capital reserves, results of operations, overview, macroeconomic factors including inflation, increased interest rates, significant capital markets and supply chain volatility, and global economic and geopolitical development have direct and indirect impacts on our results of operations that are difficult to isolate and quantify. In addition, rising fuel, utility, and food costs, rising interest rates, and necessary fears may impact customer demand and our ability to forecast consumers' spending patterns. We also expect these to forecast the consumer spending patterns. Those companies, that's exactly what it's doing. So it's trying to forecast the consumer spending pattern. We also, from the results of operation, we also expect the current macroeconomic environment and enterprise customers' cost optimizations efforts to impact our AWS revenue growth rates. We expect all of these factors to continue to impact our operations in Q2 2023. So net sales. This is results of operation, and on the result of operation, they talk about that the macroeconomic factors, including inflation, increasing the interest rates, and when you talk about the interest rate is how much money a company will charge based on loans it takes from banks or directly from the feds. Okay, significant capital market and supply chain volatility. And global exactly, significant capital market and supply chain volatility and global economic and geopolitical developments have direct or an indirect impact of the results of operations that are difficult to isolate and quantify. Even for, according to this, allegedly, according to this, they are considered that it's difficult to isolate and quantify. The reality is something that might not be disclosed. In addition, rising fuels, utility, and food costs, rising interest rates, and recessionary fears may impact consumer demand and our ability to forecast consumer spending patterns. And then I look at the net sales, right? So net sales include products and services sell. Product sales represent revenue from the sale of products and related shipping fees and digital media content where we record revenue growth. Service sales primarily represent third-party seller fees, which includes commission and any related fulfillment and shipping fees. AWS sales, advertising service, Amazon Prime membership fees, and certain digital content subscriptions. Net sales information is as follows in million. So this is their quarter for that. So in the North America, in international, this having at the slightly at net sales mix. Sales increased 9% in quarter one 23 compared to the comparable prior year period. And operating income losses. We believe that operating income is more meaningful measured than gross profit. Completely. Exactly. Gross profit or gross margin. So if you remember, gross profit is after you deduct the cost of sales, whereas operating income, okay, is after you deduct operating expense. Margin due to the diversity of our product category and service. The North America operating income in quarter one 2023 as compared to the operating loss in the comparable prior year period is primarily due to the increased unit sales, primarily by third-party sellers. So here what it does is giving you that, it's giving you a macroeconomics perspective. Operating expense, the cost of sale, of the purchase price of consumer products, inbound and outbound shipping costs, including costs related to sortation and delivery centers, and where we are the transportation service provider. Technology and content, sales and marketing, general and administrative, other operating expense, interest income and expense, interesting, or interest incomes was 108 millions and 611 million during quarter one and quarter one 2022, quarter one 2023, primarily due to an increase in prevailing rates. We generally invest our excess cash in AAA rated money market funds and invest grade short to intermediate invest grade short to intermediate term fixed income security. Interesting. Money market funds. Our interest incomes correspond with the average balance of invested funds based on the prevailing rates. So their excess in income or interest income, they invest in that. Credit rating, AAA. Non-GAAP financial measures, regulations, conditions for use and non-GAAP financial. So yeah, so the whole idea of this video is to just recap that section, that this MD&A allow investors to see from the management eye important trends in the macroeconomics, for example. Let me see here. So important trends, okay, whether it's on the here, on the macroeconomics factors, okay, important trends, risks that have shaped the company's past and likely will shape the company's future. So okay, and then when I keep reading about these financial statement ratios and calculations, okay, so they mention things like you have probably heard people banter around phrase like PA ratio, current ratio, and operating margin. When they talk about operating margin, much like similar to this. So when I look at the when they talk about is the operating expense here, let me see what it is. I think it's here. Yeah, I think it's here. Nope, not here. Is here, right? They believe that operating income is more meaningful measure than gross profits, because gross profit, after all, what it does is to deduct the amount of, so it deducts the cost of sales or the total amount of revenue, but you need to consider also the operating expense for that. Okay, so operating income, something that they mention here, operating margin or operating income, okay, PA ratio, current ratio, operating margin. But what does this term means, and why don't they show up on financial statement? Listed below are just some of the many ratios that investors calculate from information on financial statement and then use to evaluate a company. So these are, after all, ratios and calculations a to evaluate the financial statement of a company. As a general rule, desirable ratios vary by industries. If a company has a debt to equity ratio 2 to 1, it means that a company has $2 of debt to every $1 shareholders invest in the company. So in other words, the company is taking on debt as twice the rate that its owner are investing in the company. The other ratio is inventory turnover, cost of sales divided by the average inventory for the period. So if a company has an inventory turnover ratio 2 of 1, it means that the company inventory turned over twice in the reporting period. Operating margin, income from operations divided by the net revenues. Okay. Operating margin is usually expressed as a percentage, and it shows for each dollar of sales what percentage was profit. Operating margin, for each dollar of sale, what percentage was profit? PA ratio, price per share, earning per share. Earning per share, price per share. If a company stock selling a 20 price and earning per share. If a company stock is selling $20 per share and the company is earning $2 per share, then the company PA ratio is 10 to 1. The, the company stock is selling at 10 times it is earning. Working capital, current asset minus current liability. So this is actually one of the financial metrics to check the financial health, the working capital, debt to equity ratios, inventory turnover ratio, operating margins, PA ratios, and working capital. So again, these financial statement ratios and calculations, okay, helps investors to evaluate the financial statement of a company. Okay, all right. So that'll be all for this video. Take care. Bye bye.